Everybody, and welcome to Musings. It's a little dark because I've had power out all day. Not all day, I guess. Not for any bad reasons, actually, for really good reasons. Namely, I'm finally having solar installed. Seeing as I live in the desert, it just kind of seemed to make sense. But that means throughout the day, you just have no power in the house because they're obviously doing stuff with your electrical system. Do want to say thanks to the guys that showed up to actually do the work. Really appreciate them. And since I had a conversation recently on a podcast about labor and skilled trades, labor in particular, I especially appreciate these skilled electricians who came to do stuff on my house. So with that said, what's the topic? There's so much stuff going on, and I had a bit of trouble, and I think I'm still having a little bit of trouble of what to just sort of think about. So I guess I'm going to key off of something that's becoming a major trend in my sort of presentations. So maybe this is a solo practice, if you will, just kind of thinking through some of the things I do want to talk about. I'm speaking at NARPM in March. I think I'm addressing a real estate company here in Vegas in a week or two. And I think about like what will be useful, what will be valuable. As you know, I tend towards the doom mongering side, and I'm trying to get away from that a little bit. But there are all these important trends, and some of them are, interesting, let's say, and not necessarily all that positive. What occurred to me as I was thinking about the topic that I wanted to just kind of explore with everyone today is that I'm not an economist. I don't know if that's a plus or minus, because most economists are employed by somebody who might have a particular point of view. I am not. So I just look at these things like an untrained economist and try and think through them. Having said that, I don't know. Let's just walk through it and you tell me, whether you think I'm kind of on the right track or you think I'm just crazy and I should just stop talking. Which, if you believe that, then let me know. I'd be happy to take that under advisement. In any event, I got an email this morning from a PR company. Unfortunately, I can't share it because it's embargoed until Thursday. But it got me wondering, and let's just say that the news that will come out on Thursday would be an interesting piece of news. But what I wanted to talk about was foreclosures, because that's what the email is about. It was talking about January 2020 foreclosure data. So I went back and looked at the December one since it's already made public. So this is a report, obviously PR Newswire, from Adam, a real estate data company. Let me enlarge this so you can see this a little bit better. So here's kind of what it says, right? So first of all, the top line sort of headline is U.S. foreclosure activity at an all-time low in 2021. Probably makes a lot of sense. I mean, 2020 was an insane market, as we all know. Things were flying, houses are flying off the shelf. It almost makes you wonder how there were any foreclosures. Like, did you not think to just list your house and sell it in 3 days with multiple offers? But somehow it happened. So this is kind of what they reported, that 151,153 properties in the U.S. Had some sort of foreclosure happen, in 2021. But this is an all-time low. It's down 29% from 2020, down 95% from a peak of almost 3 million in 2010, lowest level since tracking began in 2005. So really good news, right? In a sense. Again, I don't know how 151,000 people didn't think to just list their house and sell it, but they didn't. So they got, the default notices, bank repos, all that stuff happened to them. Now, that's really good news. But here's the piece that I found sort of interesting. Let me see if I can zoom in a little bit. See if this helps. All right, maybe that helps a little bit. Okay, so what it says here is report also includes new data for December 2021, showing there were 17,971 U.S. properties with foreclosure filings, down 8% from the previous month, but up 65% from a year ago. Okay. So I was like, wait a minute. So it's good news, for the year as a whole, lowest level of foreclosure ever. But December, it was up 65% from December of 2020. Right now, obviously, December 2020, we're still in the midst of the whole pandemic stuff. I believe all of the moratoriums and all of that had been happening. We know that a lot of those have elapsed. And we know that some people were wondering, like, are we going to see a flood of inventory at the market because, foreclosure, people out of work, people lost their businesses. So should we see that? Maybe we are, right? So up 65% from a year ago. Let's scroll down a little further because there's some more interesting things. So here's sort of the big high level takeaways, right? In Q4, total of 56,000 properties, foreclosure filings, up 23% from the previous quarter, right? So up, even though a year as a whole, lowest level ever, but Q4 was up from Q3, and year over year, it's up 82%. So suggesting that more and more homeowners are getting in trouble. So they are getting foreclosed on. Now, having said that, like, look at this, right? The average time was actually 940. Like, dude, that's like 3 years. So, I was like, okay, fine, foreclosed 3 years long. So this all began, in 2018, 2019. But this is the part that I found was sort of interesting, right? That almost like 9,165 properties started foreclosure in December, right? Okay, that's down 12% previous month from November, but up 55% from a year ago. So over 9,000 homeowners got foreclosed on, or the process began, right? Notice default, that sort of thing started happening, up 55%. And that was started in 2020, in December of 2021. I'm like, that's really interesting. And again, I can't talk about the news that's going to drop on Thursday, but if you're interested in this topic, I would keep my eyes peeled on that. At the same time, I saw this from one of my favorite blogs. I wish I knew who wrote this. I actually looked for the author information. It's a blog called Confounded Interest, online course notes for financial markets and real estate. Just judging by some of his like hashtags and some of the people that he follows, I think he and I are kind of the same mind. But it appears to me that this gentleman, and I think it's a man. I mean, it could be a female, but just judging by kind of the humor, the language, I feel like this is a man who's writing this. And I feel like he and I sort of see eye to eye on a number of topics, but I think he works in finance because he uses a lot of things, a lot of data like this from Bloomberg terminals and other things that I just don't have access to and I don't know how to use. But here's the top line, right? So his point is the market is slowing down. Mortgage purchase applications down 12% year over year. Refi down 50% year over year, right? So this is a chart that kind of made me go, huh, right? Mortgage applications, look at this red line, right? Down 12% year over year. Huh. Obviously, it's related to this, right? That the rates are going up. And rates are going up because the Fed has come out and said, we are going to start raising rates. We're going to, stop buying mortgage bonds, potentially even sell mortgage bonds, the fiscal, the monetary tightening kind of thing. They're like, okay, so mortgages are down. So buyer demand has fallen off. In December, we saw a pretty substantial increase in foreclosures. So at the same time, the inventory is potentially kind of going to hit the market. Buyer activity is way down, right? Or buyer activity is down. Buyer interest is potentially heading down. Huh. Okay. So keep that in mind. Again, I told you this was a bit disconnected. I'm trying to weave it all together. At the same time, there was January CPI preview. This also will come out Thursday, right? The expectation from market analysts, here again, I'll zoom in a little bit so you could see a little bit better. All right. So here's what it says. The CPI, Consumer Price Index, released by Bureau of Labor Statistics Thursday morning, is expected to be 7.2% for January. All right. Fastest rise since 1982, as well as acceleration from the 7% in December. So we all know 2021, it was, like the worst inflation numbers in like 40 years. Okay, well, January is going to be worse. And that's the expectation right now, right? And if you read through the article, this is why. So consumer prices rise to nearest highs in nearly 40 years. Like, look at that. That's a spike. We're not quite at this level yet, but that's if you trust the numbers. Because as I've kind of mentioned, and people like George Gammon, Luke Roman, some of these folks, I've been talking about how you can't trust this necessarily because CPI's methodology has been changed in about 1982. So, there are a lot of folks who think that true inflation is more like 14.5, 15%. But in any event, so think about this. This is kind of what the analysts, the economists think is happening. So energy prices being boosted by rising oil prices, vehicle prices being driven by ongoing chip shortage. So a lot of it's around, energy. Fuel is expensive. It's wintertime, so natural gas, oil prices are high. People have to heat their homes. And, sort of the global supply chain. And that's kind of the reason given. But then I'm like, okay, meanwhile, rents are likely to continue to see upward pressure owing to high prices for homes, impacting affordability driving demand. And that's the piece I'm thinking about. Like, okay, supply chain disruption could maybe account for things like why car prices are high. Home prices, sure, supply is part of it, but like the cost of construction is way through the roof in the last couple of years. Okay, but existing homes are already built, right? So we can't blame existing home prices going up 18% on supply chain issues. Like, that doesn't actually make sense. We can't blame that on oil prices. And yet we know that's up, and we know rent's going up. And housing is the largest component of the CPI. And rents are up something like 14%, last year. And home prices are up 18%. So how are we saying inflation is 7.2? Little iffy, right? A little questionable. How does this all come together? One of my big theories, one of my big theses that maybe I'm wrong. It's really, really hard to get data on this, is that it doesn't actually matter what happens to sort of interest rates. It doesn't matter what happens to mortgage rates. It doesn't matter that much. Why? In terms of home prices, why? Because I think institutional investors will rotate in and take up that demand. We've already seen, 2020, 2021, a lot of institutional money leave bonds and get out of cash and even get out of some equities. Because when you have rising rates, you don't want to be in growth stocks. And they're looking at where can we make this yield? And a lot of them have gone to residential real estate, right? I think I posted something recently talking about, there was a report from John Burns saying that something like 50 billion in equity funding is already committed to go into single family residential. We know that build to rent is like the hottest trend for home builders. Entire communities, subdivisions being built specifically to be used as rentals. We know investor activity and investor interest at an all-time high. And we see that in stories like this one. Austin's NPR station, trying to buy a home in Austin, so are investors. And what I found interesting was this chart that they provided. I mean, wow, right? Like, look, Austin's always been a great town to invest in because there's a lot of demand, a lot of people moving in. But, look at the steady. And then 2020, bang. I mean, what is that? Like, it went from 17.6 to 28%. Like, yo. And this is how they define the investor, right? So you could look right here. Investor is defined as a non-individual. So LLC, a corporation, a trust, whatever, or an individual buying 3 or more properties at once. So we're not talking about like it's like somebody, a family, they bought a home, then 2 years later, they bought a condo. No, we're talking about an individual coming and saying, I'm going to buy 3 condos at once. That is clearly an investor. You're not living in 3 condos in Austin. That doesn't make a whole lot of sense, right? Which I think explains this, right? As the median price of a home in Austin rose nearly 28% last year. Yeah, some of it is because of all the Californians in New York and Chicago, like all the urban folks from cold Northeast COVID lockdown states moving to Texas and moving into Austin. I get that. But I have to think of some of it is related to this, right? I mean, some of it has to do with the fact that like investor purchase share went from 17% to 28%. Don't even tell me that's not happening. And those investors I'm betting are not that sensitive to mortgage rates because they're not using mortgage. They're not borrowing money to buy these homes, they're just paying cash. So why am I talking about this? Why do we care? Well, I mean, we care because we're all in the industry. But in terms of presentations, a big thesis of mine is that I think we've been kind of heading this way for years, but COVID and the government response to it has accelerated a lot of trends, right? The biggest one is towards renter nation. Like millennials, they're not at 50% home ownership. I think last I checked, they were like 46%. And this trend is making it even harder and harder. So we're moving towards that. Now, we could certainly have some conversations around what this means for us as a country, as a society, how terrible this is, how we need more affordable housing. We need to build more. It's fine. Like that's all true. But for real estate, for the audience that I'm going to end up speaking to, which are mostly brokers and agents, certainly will address kind of the social, political, cultural impact of something like this. But what does this mean? What it says to me is I think sales side of real estate is going to be under enormous pressure. It's going to result in some distortions we're already seeing, we're already kind of sensing. So my interview with Jim Kling, if you saw that one, we went into quite some depth of discussion around that. Jim, again, being a broker, 35 years of experience, his view was that we're starting to see more and more off-market and pocket listing activity because these big agent teams are feeling like I need to feed my buyer's agents on my team. So I'm not going to just list this listing in the open market. I'm going to keep it pocket. I'm going to keep it off market, generate the leads, which I can then send to the buyer agents on my team. Again, there's no proof that that's true. No one's ever done a study around it that I'm aware of. But I feel like Jim's a pretty, reliable guy. He doesn't seem to be pushing any kind of an agenda. And if that's what he sees in his market, and I've talked to some other agents, since doing that recording, there's some there. I think it's maybe you guys, kind of have to let me know. Am I crazy? Is Jim crazy? Are you seeing this in your market? I know there's been studies. There was a report recently showing that a lot of agents are suggesting that they're seeing more and more off-market listings in their market. Why is that happening? Could be this, yo. Right. I think there are going to be fewer and fewer sales. Again, if mortgage applications are way down, foreclosures up in December. So even though inventories come in the market, buyer activity is going to be lower. Investor activity is at an all-time high, and interest at an all-time high because CPI at 7.2 nominal, real CPI being like 15%. A lot of very wealthy people, family funds, private equity, insurance companies, hedge funds, whatever, they're going to look at where can we generate yield. And I think real estate makes a ton of sense. But that means to me, like the sales side of things are going to, I think, decrease over 2022, right? So it's still an incredibly hot market. Don't get me wrong. I still think we're going to sell, I don't know, we'll probably be north of 6 million units for 2022. That's not what I'm suggesting. What I'm suggesting is maybe it gets more concentrated. I think we're going to see more off-market activity. We're going to see more pocket listings. We're going to see more of that. Why? Because the type of buyer will change, right? So it's not going to be as many, 30-something couple with a baby on their way looking for the first-time home because they can't afford it, right? I mean, their wages haven't gone up 18%. Home prices have. I think it's going to be more investors. And look, I hate to say it, but I think they're going to find it easier to work with, let's say, the top agent in a given market and say, listen, we're looking to buy 200 units. Go find them, go buy it for us. And that agent then has a vested interest because of the economics of the team to say, okay, well, I'm going to keep as many of this, as pocket as possible. There's another angle to this. I think what this suggests to me is, again, this is a total guess, right? Like none of this investment, this is like, but it says to me, I'm really looking forward to Open Doors quarterly earnings call, which I think is coming up in a week or two. I think Open Door and the iBuyers are going to have a great 2022. By the way, I include in my definition of iBuyers the so-called power buyers, right? Where you bring, you could use our cash to buy the next home. I think they're going to have a really good year because what's happened mortgage, because as more inventory potentially comes online, thanks to increased foreclosure activity, high CPI, like economics are going to be really uncertain. Investor activity, I suspect they're going to do well. So my rationale in is this. Like I said, I can't even understand how 150,000 people went into foreclosure at all. I mean, in the hottest real estate market ever, just list your house, sell it. Maybe those folks, might not want to go through the trouble of listing their house and selling it because the transaction still is very painful. But if they have the opportunity, they would absolutely sell it to Open Door, right? They would absolutely sell it to an iBuyer who's going to come in and say, we'll give you cash right now. And you can get out and you have some equity. As the foreclosure report talked about, American homeowners have enormous amounts of equity. Don't get foreclosed on, just sell it. And then you have to move into rental or, move out of town or whatever it is, but better than getting foreclosed on, right? So wrapping it all up, what does that mean? I think sales side is going to decrease 2022. I think obviously we don't know, the Fed hasn't actually raised rates. We haven't seen any of this actually happen. We don't know, but that's kind of my gut feeling right now. What that means though, is if the sales side goes down, I think the rental side is going to go up. So like I mentioned, my presentation is to NARPM, the property management conference. I think I'm probably gonna have really good news for them because I'm like, you guys are about to be in the catbird seat. Your segment of the industry is about to blow up because I don't think millennials get to 50% home ownership. Not at these trends. Not until something dramatic changes, like in the next couple of months, and I just don't see that happening. So they have to live somewhere. Like all those people that are getting foreclosed, they have to live somewhere. They're probably not buying another house after they sell their home to Open Door or get foreclosed on. So they're going to have to rent, which means property management and investor activity, all like property management. So that's just something I've been thinking about. I've been talking about. I've been writing. If you saw my interview with Scott Brady, we talked about that. I need to, really figure it out and distill it out a little bit more. But since you're watching my musings, you're with me for the ride as to why I think this is going to be important, like what the trends are and what this then means for the industry. What else? When you think about it, like just think about that, right? The idea that maybe sales activity is going to decrease in 2022, but rental activity will increase, investor activity will increase, property management is going to become more important. Obviously, that has obvious implications for brokers and agents. It has obvious implications for like MLS and associations too, though, right? And I know there are some MLS that are out there, doing more on the rental side of things, like Rental Beast, and some of these companies have been making some traction. That's probably going to accelerate, I think, in 2022. And if not, they might be left a little bit behind the curve because these trends are macro. These trends aren't going to change anytime soon. And, we'll see what happens. And that's just my high level, just strategic thinking about it. Anyway, that's it for today. If you have any thoughts or you have any questions, you have something you want to add, let me know. Holla. All right. Thanks, everybody. Bye.